Hey everybody, it's Spencer Hakimian and welcome back to another episode of What's Moving Your Money on Forbes. On today's episode, we are covering the K-shaped economy, the winners and losers of the 2025 economy, what it all means for the second half of the year, and what inferences we can make about this going forward as it relates to the stock market. So sit back, get ready, and I hope you guys enjoy. So recently there's been this coin term that's called the K-shaped economy, the K-shaped recovery, and it essentially means that the economy is operating like a K, right? There are some people that are significantly benefiting, which is the upward sloping part of the K, and there are some people that are significantly hurting, which is that downward sloping part of a K, if you visualize what a K looks like, the letter K in your head. Now, this is particularly confusing because we are taught and we growing up thinking that the economy all moves in one direction with one another. But that's actually not so true. The economy is much more of like many different parts that are all rolling at different speeds and in different directions than one thing moving in perfect direction and form and speed and shape all together at once. So I think it's very important once in a while to just take a step back from the broader macro numbers. And yes, I am a macro guy, everyone knows that. But I think it's worth taking a step back every so often and just looking at the actual parts of the economy and seeing, hey, look, are there some parts that are thriving? Are there some parts that are hurting? So let's break this down a little bit closer right now. Let's start with the parts that are hurting because frankly, this seems like it's a little bit more of the economy from my vantage point right now. When I say more of the economy, I'm referring to overall parts of the economy, the larger parts, so on and so forth. We have a housing sector that is basically dead in the United States right now. We just had our worst spring season for the housing market ever. Interest rates are too high for housing. Homes are not being sold. Homes are not being bought. Nobody is willing to leave a 2.5% mortgage that they got in 2021 to move into a new home that they would have to get a 7% mortgage to replace it with. At the same time, incomes to home prices have never been worse. Home prices are historically expensive in the United States relative to income. So much so that it's worse than 2008. You would be shocked, but that is a true fact. In 2025, homes relative to incomes are more expensive than they were right before the housing and financial crisis of 2008. Now, beyond just housing, we also have quite a weak consumer right now. As you guys all know, 2/3 of the American economy is consumer and consumer spending. So it is very important when we see the early signs of a weakening consumer. Even in today's GDP report that came out positive overall for the economy with plus 3% real growth for the second quarter, which is amazing. It's good to find out, get that news. But when you look at the consumption part of that equation, it is really weak. It is barely growing north of 1% right now. Now this compares to positive 3, even positive 4% growth back in 2023 and 2024 in real terms. So in real terms, we have a consumer that has gotten 300 basis points weaker since just last year. Now, there might be many reasons for this. You can say it's tariffs. You can say it's uncertainty. You can say, people are just exhausted. You can say COVID funds have run dry. Whatever it might be, you can say interest rates are finally taking a toll. There are a lot of things that are headwinds that are slowing down the consumer. And frankly speaking, this is really, at the end of the day, what you want to be focused on most as an investor is what is the health of the consumer? Is it improving? Is it getting worse relative to what we thought just 6 months back? Because at the end of the day, 2/3 of the economy is consumption. It's personal consumption, right? All these other things, exports, imports, government spending, transfers, whatever it might be, that is marginal. It matters. It is 1/3 of the economy, but it is not as significant as the consumption element. So it's worth thinking about it quite clearly. Now, look, I said it's a K-shaped economy because there's also some good parts to this, and we have to talk about it, and it's also really good, right? Thank God there's some parts of the economy that are doing better than housing and the consumer. As an example, AI, CapEx, artificial capital expenditures from companies in the technology space is exploding. You guys saw Microsoft, Meta, Amazon, all these companies that I've reported, they're saying that their AI numbers are growing 35% year over year. And that's great because AI requires a lot of data centers. It requires a lot of chips. It requires a lot of transportation of goods and real products. So it's great. People think of technology as a pure service, but what you don't understand is that technology is servicing a real good at the end of the day. Whether that's advertising for real products on Facebook, or it's trying to better understand education through ChatGPT. These are real things at the end of the day that come out of these products. So look, the good of our economy right now is AI, it's corporate CapEx, it is anything that's not related to tariffs, that is related to Wall Street. It's going well, and that's good. Earlier in the year, I personally thought that we were going to have, because everything else slowed down, we were going to get a slowdown ripple through into the AI, into the technology sector. It hasn't happened yet. That's not to say it won't happen at all, but as of now, it hasn't happened. So that's good. We should be happy about that if you ask me. And look at the NASDAQ. It's on a good run lately. I think it's verifying some of that. I think it's proving that certain parts of the economy that are insulated from tariffs, that are a little bit more insulated from just purely consumer spending, are doing a little bit better. But again, I want to stress, we shouldn't forget about those other things. We shouldn't forget housing is weak. We shouldn't forget the consumers having a tough time. We shouldn't forget auto delinquencies are on the rise. We shouldn't forget credit card charge-offs are rising, right? These are the warning signs that you want to know ahead of time. You don't want to find out about this once we're in the middle of a problem. You want to know ahead of time. So it's my duty to inform all of you about it. Now, guys, before we go today, I want to briefly talk about earnings, because I think this earnings season is the perfect microcosm of this K-shaped economy that I've been talking about. And guess what? I'm going to be talking about it more going forward, because as I see it, it's getting more noticeable, not even less. This is becoming more apparent. If you look at Meta and Microsoft today, their earnings were fantastic. Not only did they beat for the second quarter, but they raised guidance for the third quarter, right? They see strong demand ahead for their products. Yes, some of that strong demand is actually coming from Europe and Asia. It's not coming from the United States. But even their local domestic businesses, they are saying, is holding up strong for now. Ad spend is good. Hardware sales are good. Microsoft Suite sales are good. Microsoft Azure, which is their version of data centers, which is the cloud, is good. All of these things are good right now, and that's a good thing. It's a very good thing. Look how good stocks are up right now. My portfolio is doing well, so I'm happy about it. How about you guys? Let me know in the comments, as always, please. But then, we look at the other half of this equation. Ford and UPS just today reported horrific earnings. Horrific. Ford just said that they now expect their 2025 hit to their earnings from tariffs to be $2 billion versus their estimate just a quarter ago of $1.5 billion. Ford doesn't even make $5 or $6 billion a year worth of profit. We're talking about almost half of this company's profit getting wiped out because of tariffs. It's going to lead to layoffs one way or another. We can't be naive about this. Over time, if companies' profits fall, they have to lay off people. It's just that simple. UPS, if you want to look at UPS as a bellwether for the shipment of goods, if you want to look at UPS as a bellwether for the upcoming Christmas season or for the upcoming back-to-school shopping season, however you might want to look at it, they are lowering their guidance for the year. what they are seeing is a very different economy than what the tech leaders in Silicon Valley and San Francisco are seeing. Neither is more important or less important. It's just different. It's amazing that Microsoft and Meta are doing great, and it's very sad that Ford and UPS are not doing great. Look, overall, I think we have an economy that is not thriving. It is surviving, right? It could be doing a lot better had we not done all these extracurricular activities in the big first half of the year. And ultimately, I tend to think that as a consumer weakens, everything else slowly drifts like gravity towards the health of the consumer. Because if you have 66% of anything pulling you down, it's a lot harder for that other 33% to sustainably lift you up. So guys, I want you guys to comment, what are you seeing? Are you seeing in your hometown, in your local job market, in your local housing market, in your personal earnings, in your personal 401k, are you seeing this K-shaped economy? Are you seeing some people and some companies that are thriving while other people and other companies are suffering? Let me know in the comments, and I can't wait to see you guys on Friday.